Today, 3 dividend investing strategies, whether you're beginner, intermediate, or maybe you're pro and you have a 6-figure account. I don't know, but we're going to break all these down because they can all help you out along the way. So let's jump right into this. Welcome back, passive income investors alike. Today, this is going to be an awesome video because I think this is going to help us gauge all of our investing ideas kind of into a channel so we can understand where we are and where we're going. Now, usually I'd update my 6-figure dividend portfolio, but unfortunately, because the Canadian markets are closed, it's Canada Day, the US markets are open, Apple, Microsoft are doing really well today, but unfortunately, I don't want to look at my portfolio unless all the accounts are open so I can get a full understanding of what's going on for you guys. But instead today, I thought it would be a better idea to specifically talk about some strategies that I think could help give us a bit of a direction in where we're going in our investment future and careers. Start with a numero uno here, which is you're the first person getting into this. No one's really talked to you about it. You just kind of stumbled upon it on the internet maybe, and you want to get into dividend investing. So strategy number 1 is you have no strategy. You're just getting into this, guys. So what are you going to have to do if you're new to this game? First thing, you're going to have to find some cash flow, some income. You need to get some income coming in. You need to get that income coming in first, get all your debts and bills paid off, and then with the extra cash flow you have at the end of the month, you're going to try and save up maybe $400 a month, $500 a month, $1,500 a month, whatever works for you, and you're going to invest it into an account. Now, you have to figure out what accounts are going to work best for you. Obviously, the best account you can possibly get is a tax-free savings account, or also known in Canada, here's a TSFA, a tax-free savings account, or TFSA, let me say that right, not TS, TFSA. And essentially what this account does is it allows you to contribute, after you've paid your taxes, you contribute to that account, and then you're going to be able to make any money you make in that account completely tax-free. All the dividends, everything you make up to a certain amount, because you can only contribute so much, and you're going to be able to draw on those dividends, and you'll be able to do whatever you want with those dividends completely tax-free. So now in this beginning stage, guys, because you don't really have a strategy, you're gonna have to figure out what suits your best morale. For instance, maybe you don't want to focus on individual stocks and you don't have time for that and you want a more passive investment. So you're gonna be looking into ETFs. And what an ETF is essentially somebody jammed a bunch of companies together in a portfolio that they manage. They charge you a tiny management fee and you don't have to do anything, and usually you can make 8 to 10% a year, especially in something like a Vanguard 500 index fund or the S&P 500 index funds, which make up the 500 largest companies in the US. And it's managed very well. And I think in Vanguard, the fees are like 0.5 or 0.05%. It's really, really, really tiny fees. So that's more of a route. Or if you're more into an individual investing like I am and you want higher growth, more payments, you're going to look into individual stocks. Now, because you are new to this is the best time to be looking into individual stocks, because any mistakes you make, you're going to make with smaller amounts of money because you're just starting to contribute. So honestly, if you are new to investing, I would recommend with no strategy, start taking on some risk, maybe look at some higher growth companies and try and grow the account, because even if you do make a mistake and you lose money on something, like I said, because you're brand new to this game, something tells me you're not going to be making like a $10,000, $20,000 individual investment. So if you're just starting off with a few $100 or $1,000, don't be afraid to dip your toes in the water and buy an individual stock, or maybe even look into some other ETFs that you enjoy personally, or even mutual funds. But go on YouTube, learn about it, and start absorbing, because that's your only strategy when you have no strategies. Learn from everybody else, start getting your feet wet, and start building up the account. So let's say you've been moving along the line, you've built up some equity, maybe you've got $20, $30, $40, $50,000 in the account, you're starting to max out your RSP, maybe you're looking into opening up some other accounts. At this point, guys, when you've had that little bit of money built up, and I'm going to say anywhere from $10,000 to $50,000, you're going to be looking into what I'm going to call growth investing. And you don't have to go down this route, but this means you're just starting to get there. And what you're going to be seeing is the growth in your account. Even if you're buying safer investments, you're really going to start seeing the growth at this point when you start investing serious money. And to me, serious money, again, is around $10,000, because if you are looking at dividends and say you find a REIT, a real estate investment trust, which is just real estate companies, they buy real estate and they have to pay to their shareholders a certain amount of their rental income. So say you get a REIT that pays you 6%. On $10,000, you're going to be making $600 a year, which I think works out to be, what, $50 a month on average, which is really, really awesome. So when you start getting to that 10,000 plus range, you're going to start seeing the growth, and you might also want to start looking for higher growth companies still. So you might want to keep taking out a little bit more higher risk, diversify a little more. If you have 20, 30,000, maybe divide it up between 5 or 10 companies or something like that, or start building out your own little ETF in like an M1 Finance. I'm not the biggest fan of over diversifying in this stage. honestly, when I think you're in the growth cycle and you only have $40,000 or $50,000 invested, you should be focused on higher risk, because again, don't put all of that money into one investment, but I think you should start diversifying it out slightly into still what looks like growth investments, or even still put 50% of it into an index fund and then put the other 50% into individual stocks that you personally like, that fit your morale, that you've educated yourself on and you feel like you have an edge over most people on. That's probably your best route once you get to this stage. When I was in the growth stage of my portfolio, I was buying companies like Canopy Growth Corp, which exploded. I ended up making $22,000 in profit on. In this stage, guys, you're going to want to still take out some higher risk, just like in the beginning. But in the beginning, while you're building your strategies and picking your investment philosophies, that's when you're going to figure out how you're going to get your growth. Because maybe your growth to you isn't taking out higher risk companies. Maybe your income is high enough that maybe you're making an extra $2,000 to $5,000 a month and you don't know what to do with it. So your income from your high gross or high risk company or wherever you're working to make that income, not that it's a risk thing, but usually higher income comes with higher risk, because usually high income means not for long. It's like the NFL, right? But if you have a high income outside of the stock market, then maybe you don't need any more risk. Maybe all your risk is in your business and you just want to buy an ETF. So you're going to funnel $2,000, $3,000, $4,000 a month into these ETFs that are just going to be safe, stable, and they're going to grow quite consistently with your own income. So these strategies are based on your own set of circumstances, because obviously it really comes down to as well, do you own a property? Because we're going to get into that in a second too. But let's move on to the last one here, guys, and I'm going to explain to you risk knowledge tolerance and what I mean by that. But so this third strategy is, again, more for the guy that has 100,000 plus. When you start getting into that $80,000, $100,000, $200,000, $300,000 range, or even the $1 million range, it doesn't matter where you are beyond that. Once you get into that $100,000 plus range, you're going to be maxing out your accounts. Your RSP is probably going to be maxed. Most of your retirement savings accounts, including your tax-free savings accounts, they should be maxed at that point once you start getting into that six-figure range. And at that point, it's more important to secure it than it is to put it at risk. So maybe you'll diverse it out, put half of it into a safe ETF and divide the other half out between 10 companies. At this point, you just want to be really careful. You want to buy good, stable companies, and any risk you put into this portfolio, you want to mitigate it, make it really small, like I do with, like, say I bought Tesla, I went down 40% on that position, but because that position only makes up like $3,000 of my entire portfolio of 110,000, I'm down like $1,000 on it, but $1,000 doesn't even really affect the portfolio because I own such a tiny piece of it. But long term, I think it'll be fine. I'm not here to talk about Tesla today, so let's keep going on here into the last and final thing. So once you get that kind of money, guys, you're just going to be looking for security. The only strategy you need to understand is keeping it safe, because even if you can make 8% said and done, 8 to 10% on 100,000, that's an extra $10,000 a year. That's almost $1,000 a month in passive income, and that's just in equity and dividends, guys, because that's usually the rate of return. That's the average market rate of return, just so you are aware. So on 100 grand, you can get the average market return of 8%. You're making an extra $8,000 a year. At that point, you don't need to be worrying about taking on higher risk. You just want security and keep that income safe and reliable, because now it's getting juicy, baby. Which leads us into the final thing that isn't part of the stage 3 strategy here, but the 3 stages and strategies leads us up to the last one. Once you max these accounts, you're getting 6 figures in the bank, you need to start looking at leverage, and you need to start looking at real estate. So once you get to the point where everything's maxed out, at this point you're better off trying to find some way to mitigate your income into a tax-deferred business or piece of real estate. And what I mean by that is, once you get this much money, the next thing you're going to be worried about is what I'm worried about, which is taxes. And essentially taxes come down to the fact that if you invest into stocks at this point, you're going to be paying full taxes on the income, you're going to be paying full taxes on anything you make on the stocks or investments or your dividends for that matter. So the next thing you need to start doing is looking for another way to produce dividends. And you can do this through leverage, you can do this through real estate. And what I mean by this is, if you buy a house, because now you've got your accounts maxed, you should be saving up for a down on a property, because when you buy that property, you can put money back into it and you can defer the income. And especially if you make it a rental unit, you can rent it out, it can produce you income. You can put that money into fixing the house up, doing value adds as they call them, or just generally taking that money and putting it back into the mortgage. That way now you're growing more equity in another investment, but you're not paying tax on it, because after you've maxed all your accounts, guys, none of these strategies matter, especially when you're getting into the range where I am. A lot of you guys probably are already at this stage where you start seeing that it gets a little more painful to be investing in stocks. when you literally have maxed out all of your accounts. You really would be better off getting into real estate, in my own personal opinion. It will diversify you out of this. Now, if you already own a house, you don't have to worry about this. If you already own a house, you max your accounts, you're great. At this point, your only strategy is to continue to grow. That's it. You've divided yourself out. You got real estate. You got stocks. You're set. There's not much else you have to do except keep growing it. So every year, keep maxing out your accounts, because every year you can contribute more. Every year, maybe see if you can take out another bit of leverage or a mortgage on another real estate piece of property, and mortgage out a property again, guys, and rent it out and do that game. At this point, it's just scale. It's just how fast can you scale it? How fast can you keep getting debt and leverage and growing it? Some of you might not be comfortable with leverage or debt. Personally, I'm kind of starting to gear toward the side that debt's not a bad thing at all if you just use it right. I'm thinking about even using debt to buy an online business, because that way I can defer my income. I won't have to pay any tax on it. Buy a big business that's producing income and collect that income, guys, and then continue to grow this structure out. Now, when you are looking at these strategies, where they're going to vary the most is in this little thing I drew over here. It's called risk versus knowledge. A lot of people are scared of risk. Risk to me is like going to a school for 5 years, taking out a six-figure loan, and then coming out and praying to God you get a job that's going to help you pay that loan off fast enough. To me, that's risky. What's less risky to me is going to get a job, a safe, reliable income, or maybe working for yourself part-time, walking dogs or something, taking that income and buying the business, the kid that went to school for it for 5 years to try and get a job at the place that you're going to end up owning by walking dogs. I mean, you're not going to own the whole business, but you're certainly going to own a little piece of it, and you're going to get paid for that, and you're literally going to be the owner and the hirer, not that you're hiring directly, but you are the owner, partial owner of that company, guys. So like a kid that went to school for 5 years that spent six figures just to work at the place you own shares in, to me isn't any less risky, but it's my own risk tolerance, guys. So these entire strategies are going to be based around how comfortable you are with risk tolerance. So risk comes down to knowledge. If you know nothing about investing in real estate or online businesses or anything for that matter, this is going to be terrifying to you. You're going to be like, oh my God, I could put in the stocks move up and down daily, and like I could lose half my money, like 50% overnight. That's not how you got. If that's how you think, you're not educated enough. Because once you understand how the markets work, guys, it's short-term pain always equals long-term gain if you do it correctly. But you can only be doing investments based off your knowledge. If you know enough about real estate and you're comfortable with that, you can take out way more leverage and way more risk and understand what you're doing. If you're not comfortable with leverage or risk, it means you're not educated in a way where you think you can use it beneficially. All of these strategies will come down to what you're comfortable with. Some people aren't comfortable buying individual stocks, so they're going to buy ETFs, guys. So that's risk versus knowledge tolerance. But say you knew a lot. Like I knew a lot about Canopy Growth Corp in the day. I knew weed was going to be legal, and I knew this big wave was coming, and I was able to catch that early. And because back in the day, guys, Canopy Growth Corp traded on the OTC markets. And what that means is it's like the pink sheets. It's the trash version of the market. If I told somebody I was investing $8,000 of my money into a marijuana stock 3 years before marijuana was even supposed to be legal, people would have looked at me like I was nuts. But then again, when that turned into $30,000, all of a sudden people were like, holy crap, how'd you figure that out? Well, it took 3 years, a lot of education, a lot of patience, a lot of time, and a lot of risk tolerance, because back then I don't have enough money to make any real money off dividends, but damn, did I know what I was doing when I bought that Canopy Growth Corp years ago. So I mean, that's because I understood the market well enough here in Canada. I knew what I was doing, and I was comfortable making that investment. Some people just aren't. So what you have to do is figure out and lean into what you're comfortable with. I just spent $4,000 renting out a huge theater to do a magic show that might flop. I might completely lose money on that, but I'm leaning into things I know. I've worked my whole life in production and performing arts and magic, DJing, audio. Like I've learned I spent a decade of my life learning about this industry, so I'm better off leaning into that because I'm going to be more comfortable spending $4,000 on a rental theater than somebody that has no idea what they're doing, because I'm comfortable getting on stage. I have a set show. Like I'm just saying, that's my risk tolerance level, and I'm comfortable losing that money. But if I told you to go out and rent a theater for $4,000, try and sell it out and see if you can do a show, you'd probably be shitting your pants, because you have to get comfortable enough to stand in front of people. Like you can see, that is a good example actually, because that's a big difference in risk tolerance. Like if you had to get on stage and do something and you had to pay money to do it, you think you'd be insane. You're like, no, forget that, because you're probably not comfortable talking in front of people. But that's how we gauge risk tolerance. So if you feel you don't understand something well enough to take leverage out on it, then you should, in my mind, go educate yourself more on it. Not that you have to take the leverage out, but you have to understand that you need to be in a comfortable spot where you're okay using leverage. You're okay investing your own money. You would be okay even asking somebody to borrow a bit of money to make an investment under that. I feel like when you can get to that level of comfortability, you'll realize the risk doesn't matter. The risk completely disappears and you don't see risk anymore. And what you see is potential upside and how you can control it yourself because you understand it well enough. And that's what brings all of this together, guys. So all of these strategies comes down to what is your risk tolerance? Where's your income coming from? Like I said, if you're making a lot of income off your business, then stocks don't matter to you. Honestly, if you're making $5,000-$10,000 a month, this isn't going to matter as much because you're going to max all of these accounts out so much faster than anybody else is going to be able to. So there's no point worrying about taking on higher risk, and there's no point educating yourself in that field because you might be better off educating yourself more and growing your own business, especially if you're making $5,000 to $10,000 a month. So this really comes down to what works for you, but I think these strategies are the same for everybody. It's just where your risk tolerance is at, where your income is at, and where you want to be in the future. Because if you're not in a rush, you're not going to take on as much risk. But if you are in a rush to make a higher income, you're going to educate yourself more, you're going to take on more or risk. Let me know in the comment section below where you guys stand on some of these opinions. This is just kind of how I gauge my own investment philosophies, and I think they've worked pretty well for me, and it's kept me on track, trying to always gauge and look at the different things that are going to keep moving me forward, and trying not to take risk in things I don't understand. The easiest way to know you don't understand it, guys, is you're not willing to borrow money to do it. When I started my magic career, I took out a $20,000 loan, and I am still doing magic 10, 11, 12 years later. So I mean, don't take anything, even your own money. That's the best advice I'm going to give you. I'm going to finish this video with the best damn advice I can give you, which is, if you are not willing to borrow somebody else's money to make the investment, don't put your own money into it. It's as simple as that, guys. It's a really good way to understand something. That is my new risk meter tolerance. Risk does not exist, it is knowledge. If you are not comfortable enough investing the bank's money, your mom's money, or your dad's money into what you are investing your own money into, then you shouldn't be investing into it. It's as simple as that. So stay cool, stay awesome, guys. I look forward to chatting to you real soon.